You think you're trading currencies? You're not. You're trading expectations. And right now, those expectations are coming from somewhere most Forex traders never look: the bond market. That's why you've probably seen this happen. Good data, bullish headlines, perfect setup, and Forex moves the opposite way. Again, it's not broken. You're just watching the wrong market. A few years ago, trading Forex felt simpler. Strong economy, strong currency. Weak economy, weak currency. Today? Not so much. Now you'll see currencies rally on bad news, drop on good news, ignore major announcements completely. And traders are left wondering, what am I missing? The answer is surprisingly simple. Forex is paying less attention to today's headlines and more attention to where bond markets think things are heading next. First, bond yields tell traders what money expects. Let's keep this simple. When investors buy government bonds, they're making a bet on the future. Growth, inflation, interest rates, economic stability, all of it. And because trillions of dollars flow through bond markets, those expectations matter a lot. In fact, many times bond yields start moving before Forex does. That's the first clue. The smart money isn't reacting to the currency. The currency is reacting to the smart money. Second, this explains why good news keeps failing. This is where traders get trapped. A strong economic report comes out. You expect the currency to rally. Instead, nothing happens. Or worse, it falls. Why? Because the bond market already priced the news in. The expectation was already there. The currency already moved. The report just confirmed what investors believed weeks ago. And confirmation rarely creates the biggest move. Expectation does. Third, bond yields often reveal direction before Forex. Here's something most retail traders never notice. Sometimes Forex looks stuck, range-bound, no clear direction, but bond yields are already moving, quietly, rising, falling, shifting expectations. Then a few days later, Forex catches up. That's why institutions monitor bond markets constantly. They're looking for changes in expectations before they appear in the currency itself. Here's a real example traders experience all the time. A central bank sounds cautious. Forex barely reacts. Traders get confused, but bond yields start dropping. Slowly, consistently. Over the following sessions, the currency begins weakening. The clue wasn't the speech. The clue was how the bond market interpreted the speech. That's a huge difference. Here's the part most traders never realize. You can be right about the news and still lose the trade, because Forex isn't asking, what happened today? It's asking, what does this change about the future? And the bond market answers that question first. That's why traders who only watch economic calendars often feel late. They're reacting to information, while institutions are reacting to expectations. So here's what to take from this. The next time a Forex move doesn't make sense, don't just look at the headline. Ask yourself, what are bond markets expecting? What changed about future rates? What changed about future growth? Because in today's market, currencies aren't leading the story anymore. They're following it. And more often than not, the bond market is writing that story first. If you've ever watched Forex ignore what looked like obvious news, comment expectations. And subscribe to MarketsVox if you want to understand what actually moves Forex beneath the surface.